Imagine this scenario. You've got this mountain of complex financial documents, maybe tax forms piled up, the clock's ticking,
Yeah.
and you don't just need to understand them, you need to really master the core concepts. And fast. Maybe there's even a big exam breathing down your neck. One that demands, every nuance, every little distinction, ready for any curveball application question they throw at you. Sound familiar?
Oh, absolutely. It's that moment, isn't it? Information overload hits, and you just wish you had, well, someone to break it all down, make it digestible, practical, crystal clear.
And that is exactly our mission today. Right here on the Deep Dive, we transform complex information into clear, actionable knowledge.
Yep.
Our deep dive today is comprehensive, totally exam-focused, and it's all about the basic foundational concepts of direct tax in India. We're going to meticulously follow the detailed framework from our source material. No stone unturned.
And this isn't just about rote memorization, The goal is for you to really get the why and the how behind every single rule. Because that deep understanding, that's what empowers you to tackle any application question, whether it's on an exam or, frankly, in real life. Gives you a real edge.
Our guide for this, intensive journey, is a rich mix of insights. We've got stuff from a recent revision session on Basic Concepts CA Final Direct Tax and a detailed study material chapter. We're pulling out every key nugget.
Everything. From the constitutional backbone of tax law all the way to the nitty-gritty of specific deductions, the sometimes tricky special tax rates, and, of course, all the recent amendments. Those are vital.
So what can you expect today? We're going to unpack the core bits of income tax law, decode those crucial definitions that everything else hinges on. We'll explore that unique, sometimes counterintuitive relationship between the previous year and the assessment year. And then navigate the complex world of tax rates, surcharges, reliefs, the stuff that directly hits the bottom line.
And we're not stopping there. We'll also get into what happens with undisclosed income because, let's face it, the government's pretty interested in that.
You think?
And we'll clarify subtle but absolutely critical distinctions, like revenue versus capital receipts, or that one that always trips people up, application versus diversion of income.
Oh, yeah, that one.
By the end of this, you should have a really crystal clear understanding, something that goes way beyond just surface summaries. You'll be ready for those application questions.
Okay, let's start right at the beginning, laying the groundwork. The very bedrock of income tax in India, its constitutional mandate. Because, before any tax gets levied or collected, there has to be clear legal authority, right? It's the ultimate check.
That's the fundamental principle. It's right there in Article 265 of the Constitution. It says, plain and simple, no tax shall be levied or collected except by authority of law.
Can't be clearer than that.
Exactly. Every single tax, income tax included, must have a legal basis to be valid. Without that legislative backing trying to impose or collect tax, it's unconstitutional. Void. It really sets the whole stage.
And it's not just having a law, it's who makes that law. That's where Article 246 and the 7th Schedule come in, isn't it? Allocating power between the center and the states.
Precisely. The 7th Schedule lays out 3 lists. You've got the Union List Parliament's exclusive power, the state legislature's exclusive power, and the concurrent list, where both can legislate.
A clear division of power.
A very structured division, yeah. Ensures clarity on who taxes what.
Now, for income tax specifically, the Union List is key. Entry 82, right? That's the one that empowers the central government for taxes on income, other than agricultural income.
And that exclusion, it's hugely significant. It means the central government, under the Constitution, cannot tax agricultural income.
Which leads to that common misconception.
Right, that agricultural income is always totally tax-free. Not quite true. While the center can't tax it, state governments can if they choose to legislate for it.
So it's not universally exempt across India. That's a really crucial point for exams or, advising clients.
Exactly. Historically, states like Odisha, West Bengal, even Kerala initially, though Kerala abolished it, they did and still can, levy tax on agricultural income. The specifics depend on state law, which isn't our focus today.
Right.
But the key takeaway, especially for exams, is agricultural income isn't exempt from all government taxation, just central government taxation. Big difference.
Okay, that clears that up. So armed with that constitutional power, the government builds the actual framework.
Right.
What are these pillars of income tax law we need to know?
The cornerstone, no question, is the Income Tax Act 1961. It applies to the whole of India. It came into force April 1st, 1962. It's got 298 sections, 14 schedules.
Wow.
But the critical thing to remember, it's not static. It's constantly evolving, responding to economic changes, policy shifts.
And that evolution is mainly driven by the Annual Finance Act, right? The yearly budget exercise.
Yes, exactly. Every year, the finance minister introduces the finance bill. Parliament passes it. The president gives assent. It becomes the Finance Act. Its job. Insert new provisions, change existing ones, amend other tax laws. It keeps the income tax law dynamic.
And that Finance Act has the specific structure for rates in its first schedule, 4 parts.
Correct. Part I gives the income tax rates for the current assessment year. So Finance, number 2 Act 2024, sets rates for AY 2024-25, which relates to income earned in FY 2023-24.
Okay.
Part 2 has the TDS rates for the current financial year, like FY 2024-25. Part 3 gives rates for calculating tax on salaries and for advance tax for the current financial year, specifically for those opting out of the default new tax regime.
Got it.
And Part 4, that lays down rules for computing net agricultural income, ties back to what we just talked about.
Now, this year, Finance Act 2024 brought some really crucial amendments. We need to stress the effective date here. It's vital.
Absolutely critical. The date to circle in red is July 23rd, 2024. While there was a Finance Act, number 1, on February 1st, 2024, it was mostly minor stuff. The big changes impacting calculations, they kicked in from July 23rd. For exams, knowing this date is non-negotiable for applying the right rules.
Okay. Beyond the main act and the Finance Act, we also have the income tax rules. These come from the CBDT, right? The Central Board of Direct Taxes, making the act workable.
That's right. The CBDT makes rules to carry out the act's purpose. These are the income tax rules, 1962. They provide the admin details, the procedures. You really have to study them alongside the act. They contain sub-rules, provisos. Those are the exceptions and explanations which give crucial clarifications, integral for practical application, especially in exams.
And then there are circulars and notifications. How are they different? What's their role?
Good question. Circulars are issued by the CBDT mostly for guidance, clarifying specific problems or ambiguities in the act. Key point. They are binding on the tax department. Officers must follow them. But, and this is important for taxpayers, they are not binding on assessees. However, you can always take advantage of a circular if it's beneficial to you.
So if it helps my case, I use it. If not, I'm not bound. Sounds useful.
It can be. Notifications, though, are different. They're issued by the central government to give effect to provisions, or by the CBDT to make or amend rules. Unlike circulars, notifications are binding on both the department and the assessees. They directly change or implement the law.
Like specifying which bonds get interest exemption.
Exactly. Section 1015 for public sector bonds specified via notification, or Section 35 CCD skill development project guidelines also via notification, legally enforceable for everyone.
And the final piece, legal decisions of courts, case laws. Essential when the act is ambiguous.
Absolutely essential. When the statute is unclear or new situations pop up, the judiciary interprets the law, sets precedents. Supreme Court decisions, they're the law of the land, binding everywhere in India. High court decisions are binding within their state or jurisdiction. Understanding these cases is crucial for a nuanced grasp. They clarify how complex rules apply in the real world. And yes, they definitely show up in exams.
So with an evolving law and court interpretations, how do they maintain consistency? That's where the rules of interpretation come in, right? Guiding how laws are understood.
Exactly. Their main job is to figure out what the lawmakers really intended, especially when a provision is ambiguous or seems to have multiple meanings. They provide a framework to ensure the spirit of the law, not just the literal words, is upheld.
Let's touch on some key rules. The most straightforward seems to be literal interpretation.
The literal rule is the first stop. Stick to the plain, ordinary meaning of the words. The judge interprets, doesn't legislate. No adding, no subtracting words. If the language is clear, unambiguous, you don't need other rules. Parliament says what it means.
Black means black. Got it. But what if that leads to an absurd result? Or if the law was trying to fix a specific problem? That sounds like the mischief rule or Hayden's rule.
You got it. The mischief rule looks at the mischief or defect the law aimed to fix. Courts ask, what was the law before? What was the problem? What's the remedy Parliament applied? What was the real intention? Then they interpret to suppress the mischief and advance the remedy. It's a purposive approach.
Makes sense. asking why was this law created.
Yeah.
Then there's the golden rule. Sounds like a compromise.
It is, kind of. It allows departing from the literal meaning, but only if sticking to plain words leads to an absurd or irrational result the legislature couldn't have intended. It's about balance, considering context, making sure the interpretation fits the statute's overall purpose.
And when different parts of the same law seem to clash, harmonious construction needed there.
Precisely. Read the whole statute, all its parts, together. Avoid inconsistencies. Give meaning and effect to all parts. Make them work cohesively. Don't render any part useless.
And one that's particularly interesting for taxpayers. The principle of beneficial construction. How does that work in tax law?
Yes, very relevant. If a provision has two possible interpretations, one burdens the taxpayer, one is more favorable. The court should lean towards the one most beneficial to the taxpayer, especially in fiscal laws. It reflects a bias towards fairness when the law isn't perfectly clear.
Are there any other minor rules worth a quick mention?
Sure. Briefly, adjustum generis. General words are limited by preceding specific ones, like dogs, cats, and other animals, probably means other domestic pets, not lions. Nocitur associus, meaning comes from associated words. Words get their color from their neighbors. And stare decisis, stick to established legal precedents for consistency.
Now, courts also interpret different types of provisions differently, don't they? Like a charging provision versus a penal one.
Big difference. A charging provision, the one that actually levies the tax, like Section 4, that's strictly construed. The words must clearly impose the tax. If you're not clearly caught, you're not taxed. Machinery provisions, though the ones for assessment, collection, they're liberally construed. Make the tax collection mechanism work smoothly.
And penal provisions, like for penalties.
Penal provisions are strictly construed. Benefit of doubt goes to the taxpayer. Fairness first. Deeming provisions legal fictions that enlarge scope. Also strictly construed, but given their full logical effect. If the law deems something income, it's income.
Got it. Deemed means treated as such. What about appeals, refunds, exemptions?
Appeal and refund provisions, seen as taxpayer rights, so liberally construed in their favor. Practicality matters. Exemption and relief provisions, also liberally construed in favor of the taxpayer to ensure the intended benefit is actually given.
Okay. And to help with interpretation, there are internal and external aids. What are those?
Internal aids are within the statute itself. Explanations clarify or widen meaning. Provisos carve out exceptions or conditions, like Sections 80 GBUDGC allowing political donations, but the proviso says no deduction for cash.
Right, cash is out. What about a non-obstant clause? Notwithstanding anything contained. Sounds like it overrides things.
It absolutely does. It means that provision takes precedence over others mentioned. Section 43B, for example, starts that way, ensuring certain deductions are only on actual payment, overriding accrual rules.
And marginal notes, headings, useful.
Headings and marginal notes, only if there's real ambiguity. They can hint at intent, but can't override clear words. Definition clauses are key internal aids too. Statutory definitions always prevail over common meanings.
What about external aids? Things outside the statute.
External aids are sources outside the Act. Legislative History Committee reports can be used if words are ambiguous to understand context. CBDT circulars, as we discussed, are external. Binding on officers, beneficial if favorable to taxpayers.
And the finance minister's speech.
The speech by the mover of the bill, yes, can help understand the object or policy if there's ambiguity, but not general debate speeches. Explanatory memorandums accompanying finance bills can also help. And dictionary meanings. Only if a word isn't defined in the Act or by courts.
Wow, that's a deep dive into just how laws are understood. It's not just reading the words. Okay, foundational framework covered. Now let's get into the core cycle of taxation, the previous year versus the assessment year. Absolutely fundamental.
Couldn't agree more. The basic rule is pretty simple. Income earned in one year is taxed in the next.
Right.
The assessment year, or AY, Section 2(9) defines it, is that 12-month period starting April 1st, right after the previous year ends. That's when the income is assessed and taxed.
In the previous year, or PY, Section 3, is the financial year immediately before the AY.
Okay.
That's when you actually earn the income. So income earned April 1st, 2024 to March 31st, 2025. That's PY 24-25, taxed in AY 25-26, a deferred system.
Exactly. And for a new business or a new source of income, the PY starts from the date you set up or the source came into existence and ends on March 31st of that financial year. So a CA starts practice July 1st, 2024. Their first PY is July 1st, 2024 to March 31st, 2025.
Okay, earn now, pay tax later. That's the default. But tax law loves exceptions. When is income taxed in the same year it's earned? The sources use a mnemonic, LETDS.
Right. And the reason for these exceptions? Always to protect government revenue, to stop people potentially escaping tax by leaving the country, shutting down a business, or transferring assets before the normal tax cycle catches up. Anti-evasion, basically.
Let's break down LETDS. First, L shipping business of non-residents, Section 172.
Okay, scenario. A non-resident ship carries passengers or goods from an Indian port. Rule. Tax must be paid or arrangements made before the ship leaves. The law deems 7.5% of the freight paid or payable as income, taxable in the same year it's earned. Practical way to tax a transient business.
Makes sense. Next, E. Persons leaving India, Section 174. Sounds like pure anti-evasion.
It is. If the assessing officer, the AO, believes someone is leaving India for good with no intention of returning, then their income from the start of the financial year up to their likely departure date gets taxed right then, in the current assessment year. So, Mr. X leaves for the U.S. June 10th, 2024. Income from April 1st to June 10th gets taxed immediately in AY 2024-25. Stops people earning and running.
And T. AOP BOI AJP, formed for a particular event, Section 174A, like a one-off concert.
Exactly. If an entity like an association of persons is formed for a specific event, say a music festival, Red Flakes, and it's likely to dissolve in the same year or the next, the AO can assess their income up to the dissolution date in the current assessment year. So concert runs November 24 to June 25. Income up to June 25 can be taxed in AY 2025-26. No waiting.
Then D. Persons likely to transfer property to avoid tax, Section 175, another anti-avoidance one.
Definitely. If the AO believes someone is selling assets just to avoid tax, then the income from the start of the financial year up to when the AO starts proceedings is taxable in the current assessment year. Mr. X selling luxury cars October 2nd, 24, looking suspicious. Income from April 1st to October 2nd can be taxed in AY 24-25. Stops asset stripping.
And finally, S. Discontinued business, Section 176. Is this always immediate tax?
Not always. Here, the AO has discretion. If a business stops, say, May 31st, 2024, the AO can tax income from April 1st to May 31st in the current AY 2024-25, but they could also choose to wait for the normal next AY. It depends on the circumstances. Adds a bit of uncertainty.
Right, that discretion is key. That covers the exceptions well. It really shows the proactive stance on revenue protection. Okay, let's shift gears to the who's who in tax definitions, starting with assessee, Section 27. Who exactly is an assessee?
Fundamentally, an assessee is a person by whom any tax or other sum is payable under the Act. But it's an inclusive definition.
Yep.
It covers more. Anyone undergoing assessment for their own income, someone else's income they're liable for, a loss, or a refund due. Crucially, it also includes anyone deemed to be an assessee or an SSE in default, so it casts a wide net.
So broader than just someone who pays tax, the key takeaway seems to be every SSE is a person, but not every person is an SSE. They might have no tax liability, right?
Exactly right, which leads us perfectly to the definition of person under Section 231. Again, an inclusive definition covering all entities subject to tax. Very broad scope.
So who falls under this person umbrella?
The Act recognizes several distinct units. An individual, a Hindu undivided family, HUF, a company, a firm, an association of persons, AOP, a body of individuals, BOI, a local authority, and any artificial juridical person. These are the basic categories.
Let's start with individual, a natural person, but it covers minors, etc.
Yes, a human being, male, female. Includes minors, persons of unsound mind, though assessment might be on their guardian. For deceased persons, the legal representative is assessed, ensures personal income is tracked.
And a Hindu undivided family, HUF, defined by Hindu law, not the Tax Act.
Correct. Not defined in the Act, meaning comes from Hindu law. Basically, all males lineally descended from a common ancestor, plus their wives and unmarried daughters. A unique entity in Indian tax.
And there's that interesting case, Goli Budana versus CIT. What did that establish about HUFs?
Vital case. It clarified an HUF can continue even with only one male member. You don't need multiple male members for it to exist. Shows the resilience of the HUF structure. Common exam point.
That brings up a critical distinction.
Yeah.
Members versus co-partners in a HUF. Big impact on property rights.
Crucial point. often missed. Co-parceners. They get a birthright interest in HUF property, can demand partition, get a share, typically male lineal descendants, members. Broader category. Includes co-parceners and others like wives, daughters who are part of the family but might not have that right to demand partition.
So using your example, my father, me, and my wife, father and me are co-parceners, rights to partition. My wife is a member but not a co-parcener, no birthright to partition. That distinction clearly matters.
Precisely. Matters hugely for understanding HUF management and rights in specific scenarios.
Moving to company, Section 217, seems much wider in tax law than corporate law.
It is. Includes Indian companies, foreign companies, and even certain bodies or institutions assessed as companies previously, or specifically declared as such by the CVDT, designed to bring many corporate-like entities under the corporate tax net.
And there are classifications: domestic versus foreign, widely held versus closely held, big tax implications.
Vital distinctions. A domestic company, Sec. 222A, either an Indian company or one making arrangements to pay dividends in India from Indian taxable income. An Indian company, Sec. 226, formed under Companies Act, registered office in India. Includes specific corporations, too. A foreign company, Sec. 223A. Simply any company that's not domestic.
And widely held versus closely held. Practical difference.
A widely held company, or one where the public is substantially interested, Sec. 218, meets specific criteria, like GovTLBI owns 40% shares, or it's a Section 8 non-dividend company, or a listed public limited company, or shares held by government bodies, etc. Quite specific tests. Any company not meeting these, it's closely held. Most private limited companies fall here. Impacts things like tax on unexplained share capital.
Next, firm, Section 223. Includes LPs now, too.
Yes. Covers partnerships under the Partnership Act and limited liability partnerships under the LLP Act. LLPs treated like firms for tax. And note, even a minor admitted to partnership benefits is treated as a partner for tax.
What about an association of persons, AOP, different from a partnership?
Yes. An AOP is when persons combine for a common goal to produce income but aren't legally a partnership. Could be co-heirs joining for a purpose. Example, Mr. Yash, individual, AB & Co., firm, XPVT Ltd company, joining for a construction project. Common purpose to earn income, often for a specific venture.
And a body of individuals, BOI. Similar, but different.
A BOI is specifically individuals carrying on an activity, maybe aiming for income, maybe not. Think co-executors or co-trustees, jointly receiving income where their title is indivisible.
So key differences between AOP and BOI.
Members. BOI is only individuals. AOP can have any person, company, firm, etc., common will. AOP members usually come together voluntarily. BOI members might not have that common will. Joint income might arise from circumstance.
Then local authority, municipal bodies, district boards.
Right. Entities managing a local fund, taxable on business income, but income from supplying services within their area or water, electricity, even outside, is usually exempt.
And finally, artificial juridical persons, AJPs, the catch-all.
Essentially, yes. The residual category. Entities with legal personality not fitting elsewhere. Deities, bar councils, universities, even if not formed for profit, they're persons under the Act.
Okay, that covers the who. Now let's talk income itself, Section 224. Famously inclusive definition, right? The list isn't exhaustive.
Exactly. That phrase, income includes, is critical. It means the list in the Act is just illustrative. Other things can still be income under general principles. Broadens the tax net significantly.
The sources list many specifics. Any key ones that might surprise people or are really important?
Sure. Beyond profits, dividends, salaries. Income includes voluntary contributions to trusts, perquisites, special allowances, benefits to direct or substantial shareholders.
So even non-monetary benefits count.
Yes, the net is wide. Also includes deemed profits, Sec. 4159, capital gains, Sec. 45, insurance banking profits of co-ops, and a big one, winnings from lotteries, crosswords, races, gambling, betting, flat 30% tax, win KBC. Nirmala Tai gets a big chunk.
Good way to remember it.
What else? Employee welfare contributions not remitted, Keyman insurance proceeds, non-compete fees, Sec. 28 VERA. Also, fair market value of inventory converted to capital assets, Sec. 28 VERA. Crucially, forfeited advance money for capital asset transfer, Sec. 56, and money property received without inadequate consideration, Sec. 562X, above limits.
Those last two are big capturing transactions that might not look like traditional income.
Precisely. Also, termination compensation, Sec. 5.6 to 11, certain business trust sums, some life insurance policy sums exceeding premiums at 56.2, and generally government subsidies grants, unless specifically excluded.
What about the broader concept of income, regular versus casual, revenue versus capital.
Traditionally, income is regular, periodic, but the Act includes casual receipts like lottery winnings. Normally, income means revenue receipts, but the Act specifically taxes certain capital receipts, like capital gains. So some capital items are income for tax. Income also means net receipts after expenses, not gross. And it's taxable on due or receipt basis, depending on accounting method, though some things like interest on compensation are only taxed on receipt.
That's a lot under income. Really shows the breadth of the tax net. Okay, foundations and definitions down. Let's get to the sharp end. Rates, surcharge, rebates, where the money calculations really happen.
Absolutely. For individuals, HUFs, AOPs, BOIs, AJPs, for assessment year 2025-26, you have a choice. Stick with the default regime, Section 115 BAC, with its concessional rates, or opt out and use the optional or old regime. Big choice, because the default means giving up certain exemptions and deductions.
Let's start with the optional tax regime, the old slabs. How do they vary by age for individuals?
Okay, below 60 years. Up to 2.5 lakhs, nil tax, basic exemption. 2.5 liter to 5L, 5%, Euro 5L to 10L, it's 12,500 plus 20%. Above Euro 1,000,000, 12,500 plus 30%.
Got it.
Resident seniors, 60 to 80. Basic exemption bumps up to 3 lakhs. Slabs adjust slightly. Resident super seniors, 80 plus. Basic exemption hits 5 lakhs. Again, adjusted slabs above that. Higher exemption as you age if resident.
And that quirky rule about the April 1st birthday common exam trap.
Huge one. Clarified by Circular 28 Main 2016, if you turn 60 or 80 on April 1st, 2025, you're considered to have hit that age on March 31st, 2025, the last day of the preceding financial year. So you get the higher basic exemption for AY 2025-26. Effectively a year early benefit. Precision matters.
Definitely a detail to remember.
Yep.
Now, the default tax regime, Section 115 BAC 1A. The new normal, unless you opt out.
Right. Universal basic exemption here, regardless of age. Up to 3 lakhs nil, 3L to 7L, 5% Euro 7 euro to Glenl, 10% U10 euro to 12L, 15%, 12 euro to 15L, 20%, above 15L, 30%.
That seems simpler.
It is, and you see the benefit around 15 lakhs income. Tax is 1.40 lakhs, saving Euro 10K compared to the old regime's 1.50 lakhs. But remember, you lose deductions, trade-offs.
Next up, surcharge, the tax on tax.
Exactly. An extra tax on top of your income tax, kicking in once income crosses certain thresholds. And then there's the health and education cess, an additional 4% on income tax plus surcharge. Applies to everyone, individuals, companies, everyone. Funds, health, and education.
So cess is universal. Let's break down surcharge rates. Optional tax regime, old first.
Old regime. Total income TI up to 50 lakhs, no surcharge. 50L to 1 crore. 10% Euro to 1 CR, 15% Euro to 5 CR, 25%. Above Euro 5 CR, a hefty 37%.
37%. But there's that crucial relief for special incomes like dividends, STCG 111A, LTCG 101, 101.
Yes, vital point, very testable. For tax on these specific incomes, dividends, certain listed equity gains, the surcharge is capped at a maximum of 15%, even if your total income pushes you into the 25% or 37% overall surcharge bracket.
So you have to segregate income for surcharge calculation.
Absolutely. Especially if TI Euro 2 crores. Normal income might attract 25% or 37%, but the tax on these special incomes only gets hit with max 15% surcharge. A deliberate relief.
Significant protection there. What about the default tax regime, new 115 BAC, surcharge rates?
Slightly different. Up to 50 LTI, nil. 50 L Euro 1 CR, 10%. 1 CR to 2 CR, 15%. Above due CR, capped at 25%. Importantly, no 37% slab in the new regime.
Lower top rate.
Yes, and the same 15% surcharge cap applies to the tax on those special incomes. Dividend, 111A with 1A or 112A gains in the new regime too.
This leads to marginal relief. Preventing that huge tax jump just for crossing a threshold ensures fairness.
Exactly. The core idea, the increase in your tax, including surcharge, because your income just crossed a threshold, shouldn't be more than the actual increase in your income itself. Prevents earning 1 more, costing you, say, to 10,000 more in tax.
Softens the blow. How's it calculated?
You calculate tax plus surcharge on your actual total income. Then calculate tax plus surcharge on the threshold amount, e.g. exactly 50L, quote 1 CR. Find the income above the threshold, actual income threshold income. Compare. Is tax plus surcharge on actual income, tax plus surcharge on threshold, plus income above threshold? If yes, the difference is your marginal relief. Your final tax is capped at the lower amount. Applies at each surcharge boundary.
That's where practicing with illustrations is key, right? Seeing it work.
Absolutely. Best way to grasp it. Very common question type.
Another key relief, Rebate under Section 87A. Who gets this? What's the aim?
Only for resident individuals. Purpose: give significant tax relief to lower income earners. Effectively makes income below a certain level tax-free.
And the amount differs between old and new regimes.
Yes. Optional old regime. If total income equal 5 lakhs, rebate is tax liability or R 12,500, whichever is lower. Effectively nil tax up to €5. Default new regime 115 BAC. If total income equals 7 lakhs, rebate is tax liability or 25,000, whichever is lower.
So new regime, effectively nil tax up to 7 lakhs before cess. Big benefit.
Huge benefit for many. Important points. Rebate is applied before adding the 4% cess. And critical exclusion. Rebate is not available on tax payable under Section 112A, LTCG, on listed equity 1.25L. You pay tax on that gain without this rebate.
Interesting. And there's that newish marginal relief on rebate, only for the new regime, to prevent a cliff effect just above 7 lakhs.
Yes, addresses that specific issue. If your income in the new regime is just over 7 or say 7,500, without this, you'd lose the whole 25K rebate. Big tax jump for 500 extra income. The rule says your tax payable can't exceed the amount by which your income is over 7 lakhs. So in this case, income is 500 over. Your tax payable can't increase by more than 500 compared to the zero tax at 7, or else smooths the transition.
Smart addition. Prevents that harsh cliff. This level of detail is exactly what's needed. Okay, moving beyond general rates to specific scenarios, partial integration of agricultural income. Fascinating, because agri-income is exempt from central tax, but still impacts the overall bill.
It is fascinating. Its purpose: indirectly tax high earners who have both significant non-agri and agri income. Stops them using the agri exemption to artificially lower their tax slab on other income. Prevents evasion, essentially.
So not taxing agri income directly, but using it to calculate tax on other income. Who does this apply to?
Only individuals, HUFs, AOPs, BOIs, and 2 conditions must both be met. 1, net agricultural income, €5,000. 2, non-agricultural income, the basic exemption limit, 3L new regime, 2.535 old regime.
So if you have decent amounts of both, this kicks in. How does the 3-step calculation work? Often tested, right?
Very common application question. Step 1, calculate tax on net agri income plus non-agri income using applicable slab rates. Call this A. Step 2, calculate tax on net agri income plus basic exemption limit using the same slab rates. Call this B. Step 3, your initial tax liability is AB. Then add surcharge and cess.
Let's use the source example. New regime, 4L agri income, 12L non-agri income. Walk us through it.
Okay. Step 1, tax on 4L plus RL plus 4L plus euro LO is 16 lakhs. New regime slab tax on euro 16 LO is 1,070,000 euro. That's B. Step 2, tax on 4L plus 3L basic exemption 7 lakhs. New regime slab tax on 7L is 20,000. That's B.
Okay.
Step 3, initial tax overall 1,070,000 A or to 20,000 B equals $1,050,000 plus cess, etc. Now, if you just taxed the 12 euro non-agri alone, tax would be 1,040,000. The integration adds 10,000 here, shows its impact.
Ensures agri income pushes other income into higher slabs. Clever. Now, rates for other entities, cooperative societies.
They have slabs. Up to 10K income, 10%, 10K, 20K, 1K plus 20%, above 20K euro, 3K plus 30%. Surcharges like domestic companies. Nil up to 1CR, 7% for 1CR or 10CR, 12% above 10CR, plus optional concessional rates exist, SEC 115 BAD BAE with conditions.
Firms and LLPs, simple flat rate?
Yep. Flat 30% tax, surcharge, flat 12% of total income euro crore. Marginal relief applies, of course.
And companies. Big difference between domestic and foreign rates and surcharges.
Domestic companies, general rate 30%, but concessional 25% of turnover in PY 2022-23 was 400 crores, surcharge. Nil up to 1CR, 7% for 1CR, 10CR, 12% above 10CR, marginal relief available.
And foreign companies. Major amendment recently, right? Effective July 23rd, 2024.
Huge one. Tax rate reduced from 40% to 35%. Big impact on non-resident tax. Surcharge rates are lower. Nil up to 1CR, 2% for 1CR, 10CR, 5% above 10CR. Historically linked to their higher base rate. Marginal relief applies here too.
Now the special tax rates. Crucial amendments from July 23rd, 2024. Vital for investment gains.
Absolutely vital. Section 112A. LTCG on listed equity MS Biz Trust units. Old. 10% on gain 1 lakh. New. From July 23-24, 12.5% on gain euro 1.25 lakhs. STT must be paid. Rate up, exemption up slightly.
Okay, but Section 112, other LTCG like land building, major change, sounds like a trap.
Big change, potential trap. Old, 20% with indexation, new from July 23-24, 12.5% without indexation. While 12.5% looks lower, no indexation can mean higher tax, especially for long-held assets and inflation. Big warning here.
Right, indexation benefit loss.
Though there's an option for land building acquired before July 23-24 by resident individual HUF, choose lower of 20% with indexation or 12.5% without. Still complex.
Huge potential pitfall. And STCG under Section 111A, listed equity MFs. Rate hike there, too.
Yes. Old, 15%. New. From July 23-24, 20%. STT paid needed. So both long and short-term gains on listed equities saw rate increases.
And the infamous Section 115 BB lotteries, gambling, etc. Still simple.
Remains flat, 30%. Win KBC, 30% off the top goes to the tax man. No deductions allowed.
Then Section 115 BBE. Unexplained money, investment, expenditure. This is where it gets really punitive.
Oh, yes. Undisclosed stuff. Core tax rate. 60%. Steep. Plus a mandatory surcharge. Fixed 25% of the tax, so 25% of 60%, regardless of income. Plus standard 4% assess on tax plus surcharge.
And it doesn't end there. There's a penalty.
Yes.
An additional penalty of 10% of the tax amount. So 10% of 60% equals 6% of the unexplained income itself. Add it all up. 60% tax plus 15% surcharge, 25% of 60, plus 4% cess on the total, 75% plus 6% penalty comes to a staggering 84% effective rate.
84%.
It's designed to be financially ruinous. Hide it, lose almost all of it. And crucially, no basic exemption, no deductions, no loss set off allowed against this deemed income. Extremely punitive.
Massive disincentive. Let's quickly list the sections bringing this undisclosed income to tax. Section 68, cash credits.
Some credited in books, no satisfactory explanation of source, deemed income for loans.
Yeah.
If the lender can't explain their source, it's deemed income for the borrower.
And for share capital in closely held companies. Common loophole was. Now, if a closely held company gets share money premium from a resident, that resident must explain their source. If not, it's deemed income for the company. Onus on the company. Exception. SEBI registered VCS.
Section 69, unexplained investments.
Investments made, not recorded in books, no explanation for source. Value is deemed income.
Section 69A, unexplained money, bullion, jewelry, valuables, MBJV. Physical assets found.
Right. Assessee found to be owner, not just possessor, of unrecorded MBJV, no explanation. Value is deemed income. Ownership is key.
What if recorded, but value understated? Section 69B.
Exactly. Recorded investment MBJV, but actual cost value is higher than recorded, no explanation for the difference. The excess amount is deemed income, like gold bought for $25K recorded at $15K. NK difference taxed.
Section 69C, unexplained expenditure, lavish spending.
Precisely. Incur expenditure, can't explain the source. That expenditure is deemed income, and it's not allowed as a deduction elsewhere. 15TL income, 3CR wedding, unexplained amount taxed.
And Section 69D, amount borrowed repaid on hundi. Traditional instruments, cash transactions.
Yes. Borrow or repay on a hundi using anything other than an account paycheck. That amount is deemed income for the borrower on borrowing or repayer on repayment. Basically, cash hundi transactions are taxed, but no double tax if borrowing was already taxed.
Wow, that covers the hidden income rules thoroughly.
Yeah.
Very little room to hide. Okay, let's shift to some fundamental nuances. Revenue receipt versus capital receipt. Critical distinction.
Absolutely cornerstone. Revenue receipts arise in the ordinary course of business sales, profit, interest, generally income, always taxable unless specifically exempt. Capital receipts relate to capital structure or assets, generally not income. Only taxable if the act specifically says so, like capital gains on selling land or jewelry.
So, key point. Not all capital receipts are taxable. Important clarification.
Definitely. And similarly, not all capital expenditures are deductible. Invest €1 in a petrol pump project, capital spend. Abandon it before any asset exists. That capital expenditure is not deductible against other business income. No asset, no deduction.
Can you give another example of a non-taxable capital receipt, one not mentioned in the Act?
Sure. Compensation for delay in delivery of a capital asset, like a machine. It's a capital receipt related to the asset, but not specifically taxed by the Act. So it remains non-taxable, even though it's money received. Vital distinction.
This leads to another critical, highly tested distinction. Application of income versus diversion of income by overriding title. All about when the obligation arises, right?
Exactly. The timing relative to when the income legally becomes yours is everything.
Let's start with application of income. How does that work? Why is it taxable?
Application. Income first accrues to or is received by you. It's your income. Then you use it to pay an obligation, maybe voluntary, maybe contractual. Because it was yours first, it's taxable in your hands even if you immediately give it away. Earning precedes spending.
So my Eurolac salary from Deloitte. If I give 50K to my mom, that 50K is still taxed as my income first. Or Mr. A directs HR to pay alimony from his salary, still his income first, then applied.
Exactly. The obligation arises after you've earned it.
Now, diversion of income by overriding title. The opposite.
Correct. Here, income is diverted at the source by a legal or contractual obligation before it even reaches you, or before you have full title. You never truly owned that bit. Someone else had a prior, better claim. Because it never legally accrued to you, the diverted income is not taxable in your hands. It's taxed in the hands of the person it's diverted to.
Subtle but powerful difference. Classic example.
The partnership deed one. Firm's profit, say 20%, is contractually obligated to go directly to an ex-partner's wife, Mrs. A, before current partners get their share. Firm has no choice. That 20% is diverted by overriding title. Not taxed in firm's hands, taxed in Mrs. A's hands.
And the lottery example. Win euro crore, but Golf takes 20L, vendor takes 15L before I get it. I only pay tax on the 65L received, the rest was diverted.
Precisely. Landmark case. CIT versus Sataldus Teraptas SC. Clarified the obligation must attach to the source of income, not just the income after accrual. Offers tax planning scope, but watch out for clubbing provisions. Sec 6064.
These concepts seem academic, but have huge real-world tax implications. Definitely exam favorites. Okay, wrapping up with some practical computing rules and a few final key definitions. Rounding off rules, critical for exam accuracy.
Absolutely vital. 2 key points for rounding to nearest multiple of 10. Sec 288AB. 1. Total income is rounded off. 2. It's the ultimate tax payable amount that's rounded off, after all deductions, TDS, advanced tax, etc. Not intermediate figures. Get this wrong, final answer is wrong.
Good tip. Quick recap of income heads, focusing on recent relevant amendments.
Salaries. Charged on due or receipt basis, whichever is earlier. Big change. Standard deduction, Sec 16IA. Old regime opt-out, still 50K or salary if lower. Default new regime, 115 BAC, now less of 75,000. Or salary if lower. Significant increase.
Wow, 75K standard deduction in new regime. What about entertainment allowance professional tax?
Deductible only for government employees in the old regime. Not deductible in the default 115 BAC new regime. One of the things you give up.
Moving to income from house property. Basic calculation.
Gross annual value, GAV, minus municipal taxes, paid by owner, net annual value, NAV.
Exceptions. When is it not taxed as house property?
Right. Property used for own business profession, taxed under PGBP. Commercial properties owned by someone whose business is letting out properties, also PGBP. But letting out residential houses, always house property income.
How is GAV determined? Expected rent, municipal value.
GAV is higher of expected rent, ER, and actual rent. ER is higher of fair rent, FR, and municipal value, MV, but capped by standard rent, SO, if applicable. No FRMVSR info. Actual rent becomes GAV.
Self-occupied property, SOP, common scenario.
Annual value is NIL for up to 2 SOPs for individuals HUFs. No municipal tax deduction. Also, property held as stock and trade by builders. NIL AV for up to 2 years from completion certificate, if not let out.
Deductions from NAV. Especially interest on housing loans. Big difference between old and new regimes here.
Huge difference, yes. Old regime, flat 30% standard deduction, Sec 24A. Interest on loan, Sec 24B. Let out property, fully allowed, SOP, max 30K repairs loan, or max Euro acquisition construction loan if conditions met completed in 5 years, certificate.
But the new regime, 115 BAC, for SOP interest, major change.
Critical difference. Under the default 115 BAC, new regime. For SOP, no deduction for interest on borrowed capital is allowed. 0. Massive impact on choosing the regime.
What about recovered arrears and realized rent?
Taxable in year received realized, Sec 25A, with a flat 30% standard deduction allowed against it then.
Co-owned property, deemed ownership.
Co-owned SOP, each owner gets NIL NAV, individual interest limit, old regime, let out, compute for property, then a portion. Deemed ownership, Sec 27, treats certain people as owners for tax even if not legal owners. Examples, transfer to spouse, minor, child without adequate consideration, specific conditions apply. Holder of impartible estate, member of co-op society with possession, person with possession under part performance contracts, Sec 53A TPA, person with lease 12 years, Sec 269 UAF.
What's the official definition of India for tax, Section 225A? More than just land.
Very comprehensive. Land territory, territorial waters, seabed, subsoil beneath, continental shelf, exclusive economic zone, other maritime zones, and the airspace above all these. Covers everywhere India exercises sovereign rights.
Finally, maximum marginal rate versus average rate of tax. Quick clarification.
Average rate, Sec 2, 10. Tax calculated on total income divided by total income. Shows effective rate. Maximum marginal rate, Sec 2, 29C. Highest tax rate, including surcharge, applicable to the top income slab for individuals, AOP, ACBOIs. Shows the top burden on an extra rupee.
And that case law, CIT versus M. Venkateswara Rao. Partner's capital contribution.
Address whether partner's unexplained capital could be taxed as cash credit, Sec 68, in the firm's hands. SC said no. Inquiry must be against the partner. Assess income in partner's hands unless evidence shows its firm's profit. Contrast with the rule for closely held companies under Sec 68, where the company would be assessed for unexplained share capital. Key distinction.
That distinction definitely matters. So after covering all this ground, what's the big picture?
We've just done a really deep dive into the basic concepts of direct tax. Covered everything essential, nuanced, crucial for exams, and just solid understanding. From the Constitution, the laws, who gets taxed, when, how. Critical distinctions like revenue capital, application diversion, and the harsh reality of undisclosed wealth.
Understanding these fundamentals really is the bedrock, isn't it? It equips you for the complex stuff, application questions, even just making sense of financial news.
Exactly. My biggest advice, apply this knowledge now. Practice questions, marginal relief, surcharge calcs, agri-integration, deemed income provisions. Mastery comes from doing, not just listening.
So as we wrap up, maybe a final thought to chew on. With tax laws constantly changing, driven by economics, technology, compliance goals, what's the next frontier? How might our very understanding of income change in this increasingly digital, globalized world?
A big question, and one that guarantees the world of tax will always keep us on our toes.
Until next time, keep digging, keep learning, and stay well informed.